Andy, it's great to have you here.
Great to be here. Thanks.
Well, you and your twin brother started the firm back in 1985 as a practice of Northwestern Mutual. And my understanding is you're still at it. I know for sure. I think your brother is still at
Yeah,
it
my
as
brother
well.
Scott is still one of my partners and one of the main principals here at the firm, for sure.
Yeah, which is pretty amazing because a lot of partnerships don't make it. And the
Yeah,
fact that you two are brothers and you're still at it and you're not at each other's throat, I think is pretty amazing. So I think we're going to have some fun things to talk about here.
terrific.
So yeah, let's talk about that. So 1985, you started zero,
Yeah,
Northwestern Mutual, big insurance organization. Today you're at about 15 billion, 40
yep,
plus years later,
yep.
and you're an independent firm, and a lot of things have changed over those 40 years. So I'd love to hear if there were one or two or three pivotal moments during that time when you thought, wow, this was a big inflection point for the firm. This is what set us on a new trajectory or a new way of thinking. What were some of those pivotal
Yeah.
moments for you?
No, it's a great question. So we graduated college in May of 1984 together, my brother and Ivy League school in
Well,
South Jersey.
that's exactly when I graduated
Yeah. Oh, good.
as
Okay.
well.
So
May
good.
of
Very good,
84.
good years, a good vintage.
It was a great
So
year.
yeah, so we graduated from a very prestigious college in South Jersey called Glassboro State College. And my brother actually had gotten a job offer, which is crazy, from IBM. They came to our campus with one job offer every year. And he ended up declining the IBM job because he had been introduced to this little startup district agency in Fairfield, New Jersey with the Northwestern Mutual. And I had actually been selling life insurance as a senior in college, selling life insurance actually to college seniors, which would be a whole other podcast, Steve, that we could, but it was good training. And so I had actually come up just to make sure that it was a legitimate opportunity for him because I thought that I had already found what I was going to do. And so when we met with these guys up here in where we are still in Northern New Jersey, we decided both after graduation to join this basic startup, Northwest Mutual District. One of the things that I think was very helpful were the senior people that were here were very focused on planning. So the business always started, our core was always about planning. And so we got our CFPs, I think, in 86, which was a little bit ahead of the curve. A lot of CFPs today, there weren't really a lot of CFPs. We also got securities licensed immediately. So we all sat for our Series 7. So even though we were fundamentally an insurance shop with Northwestern, Northwestern wasn't even in the investment business at that point. We'd actually got securities license with US Life. So we knew that we wanted to be more of a full service shop. We wanted to do planning. We wanted to have a bigger role with our clients other than just selling them life insurance. And so that was sort of the genesis of the firm. Lots and lots of decisions were made along the way. One of the things I think we were always very good with was we've always reinvested our money in the business. So we always hired people probably a little bit early when we couldn't afford them. But one of the things I've been talking to advisors for years now, it's never about expenses, it's about revenue. And it's always about capacity. And so we realize that we have to, if we're going to go into the marketplace with confidence that we can compete at the highest level and really take care of clients the way they deserve to be taken care of, then you have to build capacity. So we were never afraid to make the investment. It was always more about that opposed to the bottom line for us. There's three constituencies that we serve. The number one constituency we serve is our clients. And I talk to my manager team. We have a great team here. And I talk to the team every day that what we have to do is make that client experience better. It's got to get better and better and better. And a year from now, that we would be embarrassed, as good as I think our work is, that we would be embarrassed a year from now because there's so many more things we'll be able to do for our clients. The second is our advisors. When people ask me what keeps me up at night, the one thing that keeps me up at night is that I'm out there talking to advisors all the time about joining us. And this is their most precious resource. It is their life, it is their livelihood, it is their business, which is probably their biggest asset. And I'm asking them to roll in with us. And so I always tell them that three things have to be true for me to want you to roll in and be part of our firm and be partners with us. And the first and most important for me is they have to be happy after. I do not want to have anybody here that isn't happy. I know, Steve, if you have children, I have three daughters, they're grown now, but I know my whole adult life, you're only as happy as your most unhappy child. Well, I've been working with advisors for decades now, and I find that I'm only as happy professionally as my most unhappy advisors. So that's really important for us. So we take that really serious. The second thing that has to be true is we have to be able to help them grow. Because if we can't help them grow, then there's no reason for them to be here. I'm not interested in collecting a VIG on other people's work because I am an advisor. And then the third is that the overall economics in the long term have to work out better for them. And we think that the growth of the firm and the equity that the firm is creating will be much more valuable than any individual advisors. So, but that's the mindset for us.
Yeah. Yeah. So going back to 1984, when you and I both graduated, and I think about what sort of my mindset was back then. I went into corporate America instead of financial services, didn't get into financial services till 93. So when you started with Northwestern Mutual, did you have this big vision early on? I'm going to be the biggest advisor at Northwestern. I'm going to
No,
create this mega
no.
firm. Okay,
Well,
so
yeah.
what I want to know is like, when did that shift then? Like
Well,
what
so
was
okay.
there a switch?
It's a great question. So I never thought I was the smartest guy. I never really thought I had the right answers, but I always knew that I could outwork everybody else. And the one thing that I understood very early on was it was much more about the activity that we do and much less about the outcome. So because I can't really control outcomes. So I was actually I made the top 20 at Northwestern Mutual my fourth year. I think at the time I was the youngest person to ever do that. Maybe someone has been younger, since. And it wasn't that I worked with large clients or wealthy people, but to me, I just figured out how many life insurance policies do I have to sell if my average policy is $1,000 a year premium to basically be at that level. I broke it down. I'm a I think that life is all about intention. And I think goal setting is really, really important. And if you don't have goals, and more importantly, you have to figure out what's the activity that corresponds to achieving those goals. And then, most important, we have to be reviewing those things constantly. I always like to think about the business almost like sports, and you're in a game. And if I'm in a game and we're losing if I'm in a basketball game, we're down by 30, probably nobody's hustling very much because this game is over. We're just trying to get the heck off the court. But if I'm in a game and I'm down by two or I'm down by four and it's close, then we're hustling. Now, if I don't even know what the score is, I'm not sure how I'm playing, and I don't know how anybody else is playing either. So the reality is we need to know where we are, and we need to break these goals down. So I always broke things down monthly, weekly, and then monthly. What was the activity that I needed every week? And there were only four things that really mattered. So was I accomplishing those? And if I just focus on the fundamentals, everything else takes care of itself. And then I guess after 4 years, here I was 26 years old. I was one of the sort of leader producers in the business, and everybody wanted to know what I thought. And I'm just wondering like what everybody else is doing, because all I'm doing is really what I was told to do and what I'm supposed to do, which is the more people I saw, the more people bought things from me, the luckier I got, and the business grew that way. So I think that if you're a younger advisor and you want to build something really big, it's not so much about how big you think, but it's more about building a really big base of clients. And so, but again, we were very fortunate. I had some smart people. We hired a bunch of really smart people. And we were always into this idea that we wanted to not just have a single line of business. And the more lines of business you had, the more opportunities there was that you could actually do something for a client to get a new client. So if it was investments or if it was insurance, we wanted to broaden that scope, and that was helpful for us.
I could probably count on one or two hands here the number of people who started in 1985 that are still in the business today that have reached the level of assets that you have. So, what is it that kept you going and wanting to continue to grow long after
Yeah,
all your normal financial needs are
yeah,
met? Because most people reach some level of comfortableness and then they're
yeah.
just coast at that
It's
point.
a
You
great,
didn't. So
it's
what's
a
different
great,
about you?
it's a great question. Yeah, what motivates people beyond their basic needs? I would say I always look at this as a gift. So I got here by luck. When I was a senior going into, or my senior in college, I was working in a restaurant. I was maitre ding. I had a falling out with the boss, and I needed to figure out what I was going to do to make money my senior year. I was engaged to my first wife And she was living with an insurance agent who had a Fidelity Union life insurance office selling life insurance to college seniors. So I go home that night and I'm a little bummed out because now it's time for me to go back to the ground round. And I just the idea of $15 checks on 20% tips, I could do it, but it just seemed like a bummer. And he said to me, why don't you sell life insurance to every senior on campus? So I sat for my sitting on the beach in Ocean City, New Jersey in, I guess, 1983, studying for my insurance exam. The idea is that I got here by luck. Once I got here and we figured a few things out, I realized what the potential was. And so to me, if I can make millions and millions of dollars that I don't need, think about what I can do with that money. Think about the people that I can help. We have helped so many people over the years. I've paid for so many tuitions, forgivable loans, family members. And so to me, it would be a shame and it would be a waste for me not to take what this business is willing to offer. And so we're way past financial security, obviously, but at the same time, how much the thing that really motivates me about what we're building now is that I gave 10% of my equity to my team, not my management team, because the firm gave equity to the management team, to the people that I've been working on my practice. And it will be millions and millions and millions of dollars for them, which will be completely life-changing. And so to me, that is hugely motivating because my life won't change so much. The outcomes will be what they're going to be. Nothing's really changing. I'm not buying another house. I'm not doing anything. But for them, it will be everything. And so I would say to everyone, if you can't be motivated because you don't have the financial pressure, think about other things you can do with what you can create. Think about the people you can help in your community. If you want a voice, if you want to be able to change something, having money gives you that voice. It helps you change things. And nothing's better than helping somebody in need. So that's, to me, this has been a blessing, absolute blessing.
So obviously it takes a lot of hard work to do that, and you had to make sacrifices, you had to make trade-offs. So as you built up the business, as you did all this work, what were some of those trade-offs? What were some of those sacrifices
Sure.
that you had to make?
Yeah, I didn't miss a lot of games. So when I was young and I raised my kids, I coached my kids. I never missed games. But after a game, I would go back to work. So we just made sure that we could squeeze it in. There wasn't necessarily a lot of time to hang out. I never played a lot of golf. I still don't really play a lot of golf, my golf game shows that. But maybe someday I'll play a little more. But at the end of the day, I don't really feel like I gave so much away. I had to work a little bit more, a little earlier, a little later. And that's the beauty of the business. Not only do we have an unlimited financial opportunity in this business, which we clearly do, because I'm proof of that, but also we have the flexibility to choose. We can choose to work. I used to work Saturdays for the first 5, 10 years of the business. I would go out and I would sell a life insurance policy on a Saturday morning. People might think you're crazy. What are you doing? But I always thought, how lucky am I that I can go out on a Saturday morning and I have the opportunity to work. Most people working in corporate America, you could have worked on a Saturday, but nobody paid you more for that. If I worked on a Saturday in my 20s, I got paid more. So to me, I just looked at this opportunity as unlimited flexibility to do as much or as little as I want, when I want, and to have an economic opportunity that, as far as I'm concerned, is unlimited. So very, very lucky to be in the situation that we're in. Yeah.
Let's talk about the first 10 billion in A, which takes
Yeah.
us up to the summer of 2024. So the old joke, the first 10 billion is the hardest.
Yeah, 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 yeah.
Yeah. So how did you get to 10 billion? Was this organic? Was it acquisitions? Was it buying people's books? Like
Yeah.
how'd you get
So
there?
yeah, we as a group, and obviously at 10 billion is not my mine, it's our firm. We never bought books. And I don't think we were smart enough to go out to the world and do acquisitions because it's probably really smart. There's leverage there. We did it the old-fashioned way. Remember, we came from a Northwestern Mutual, a life insurance background, a sales background. So we were salespeople fundamentally when we started, and that was our background, our training. So we basically did this one client at a time, getting to 10. And the reality is when we met Joe Duran and the Rise Growth people, we were probably about 9. We had no capital. We had no debt, but we had no capital. We were a 1099 group. So we were really, what we looked like to the outside world was a band of pirates because we just looked like a whole bunch of separate P&Ls, but we were always a firm. We always shared resources. We always had a really good team. the partners, the four principals of the firm, always reinvested all of the revenue that the firm created in people so that we had resources. We were able to really create real capacity. But where the real change happened was when we reorganized, created equity for partners that wanted equity, and we actually had cash to be able to integrate businesses. So last year, we brought on just a little under $5 billion in inorganic growth. Obviously, you've got to grow organically, and our organic growth targets are between 7 and 10%. But now we actually have something that we can offer an advisor, but not just a better place to work and a place to grow, but equity that's valuable, cash, if that's important to them, and a place they can grow their businesses, in a place that they can create more capacity for themselves. So that was really pivotal for us.
And when did you guys leave Northwestern?
So we left Northwestern in March of 2015 after 30 years.
Okay. And then where'd you go from there? Did you just
So
go
then, yeah, so
independent
what we
or?
did, yeah, so what we did was because we didn't even know we didn't know, we rolled into an OSJ, which was very helpful and very good people, so that we didn't have to worry about compliance and we didn't have to worry about establishing an RA because again, we didn't know anything. We just knew that we needed to get out and have autonomy and open the world up for us. And then I guess about 3 years ago, it got to a point where we were just too large and we parted company. They're really good people and they're built a great business and we're happy for them. And I hope they're happy for us.
Mhm.
Yeah.
So you mentioned Joe Duran and Rise Growth. So I've known
Yeah.
Joe for about 15 years. And so tell me a little bit about that. In
Yeah.
2024, you
Yeah.
decide we're going to take on a capital partner. I'm sure you had a big
Yeah.
number of folks you could choose from.
Yeah.
So two
Well,
questions
actually,
there.
yeah. So actually in 22 and 23, we had everybody coming at us. And again, we were only 7, 8, and then maybe 9 million at the end of that period. But we were growing. I think that when people came in and saw the infrastructure we built, they were very impressed. So lots of people offer us lots of money, mostly for the principals, though. And one of the things that was important for me, and I always told the advisors, even though we were this band of pirates, that we were never going to make a deal that just worked for the principals. We were only going to make a deal if everybody benefited. And so the all the cast of characters, the PE guys, the bigger firms, everybody came at us and they would have made me a very wealthy person. And I don't come from money, so I never would have imagined that. I didn't think there was that much money in the world. But at the end of the day, I just got tired of the conversation because they were all the same. I told them what I needed, and everybody said, "Yeah, yeah, we can do that." And then in the end, it was basically pay me off and take the firm. And they didn't offer us anything other than money. There was no operational lift. There was no intellectual lift. It was financial. So I was so sick of the conversation, the distraction, that I told my team at the beginning of 24, no more conversation. We're going to put our heads down. We're going to keep doing what we do. We're going to spend 24 months, grow the firm, and then we'll figure out what the landscape looks like. Joe Duran and I share a personal friend. My brother Scott had a very good friend who I'm also friendly with, and their daughters actually play volleyball together out in California. So Duran must have been talking to Ira about what he's doing because this is the kind of the beginning of their journey. And I was like, "Hey, you got to meet Andy and Scott Schwartz." And so I reached out and said, "You should meet this guy." I'm probably the only guy on the planet that never heard of Joe Duran. I had no idea who Joe Duran was. It didn't mean anything to me. I took the call and I was really, really impressed. I was what most impressed me about Joe is we had this conversation for an hour, and he said to me, "My goodness, you guys could be $100 billion firm." And I thought, what an interesting thing for someone to say when I know that if a conversation goes long enough, there's going to be some offer. And I know how difficult advisors are when I talk to some of the advisors that are 200 million, they're going to be a billion in 3 years. And I'm like, okay, I don't know about that, but I don't want to tell you what you can't do. And for him I really appreciated that because I didn't know we'd be at 100 billion. We didn't have the setup for it, but I knew we could grow. We had a good firm. And we had a bunch of conversations and I took that deal because I realized that with what Joe has built and his expertise and the team he built, that they could give us real operational lift. So now there are about 20 professionals all practicing at the top of their license that are there to help us, and they're not on my P&L. So it really turned out to be, again, there's lots of things in life that I'm grateful for, and I'm really grateful that I didn't take the bag of money from 3 or 4 other firms because it would have been a mistake. Because where we'll end up and what's happening here now is going to be so much bigger and so much more beneficial for everybody involved. But yeah, so like life, many times it was an accident. I wasn't looking for it, and it ran me over.
Yep, yep. And then Joe shows up.
Yeah, exactly. And yeah, so it's been a fantastic. We in August of 24, the four principals rolled in. So we created a structure, a W-2 structure. The first four W-2 advisors were the four principals. And then in January, we opened it up to the rest of our advisors. And I want to say initially there was about 80%, adoption like immediately. And a lot of people have called me since to say, how do you do that? Because there's a lot of people trying to do this today. And they say, how did you get 80% basically in a month? And it wasn't a month, it was 90 days of explaining to them what it was going to look like. But the first month it was done. And I told them that the biggest and most important thing is people have to trust you. And so we've been with these people for a long, long time. And we've always tried to do what was in their best interest. So they trusted us. And we've added lots and lots of advisors over the last 15 months. And Joe keeps telling me how crazy it is, how short, these from start to finish have been, because I've never really done this before. So to me, it just seemed like this is the way it works.
Yeah.
But
So you're saying prior to the deal with Joe, all of your people were 1099
yeah,
folks?
as was I. We were all
Okay.
1099. The
Okay.
firm, I remember doing a podcast with Kipsis and him asking me something about EBITDA. And I'm like, Mike, I don't know if I should be ashamed or proud. We
What
have no
is EBITDA?
We have no EBITDA. No, I knew what it was. We just didn't have
Okay.
it because we just reinvested all the firm profit
Right.
into our infrastructure. So we were able to create something now where obviously we have substantial EBITDA and substantial revenue and
Right.
substantial growth. And there's 35 or 36 equity partners now today.
Okay.
Yeah.
So there are lots of firms who have gone from a 1099 to a W-2. So tell me about the valuation lift that you
Yeah.
get. How do the outsiders like Joe look at your firm? Oh, we're going to pay this if it's a 1099 business, but we're going to pay that plus X multiple if you're a W-2. So what kind of valuation
Yeah,
lift do you get from
well,
that?
so the way we look at this is in the future, there's so much consolidation. So we're in the third iteration of sort of this RIA business. The first iteration was people becoming RIAs, right? Because there were no RIAs. So 20 years ago, the really smart pioneers became RIAs, they had firms. And then what we've watched over the last several years is this consolidation. And I think the third iteration is going to be the mega firm. And if you want to be a mega firm, you can't buy $2 billion and $5 billion firms to become a mega firm. You got to buy big firms. So we believe that getting to 50 to $100 billion will, from a valuation standpoint, will make us much, much more valuable. We've watched our stock price over the last 15, 17 months double and a half. And one of the things that there are a couple of advantages we think that we have over the market when people are looking at who they want to join. One of the big advantages we have, other than the fact that we are private equity invested but not owned. So they are a minority partner, 5 board seats. They have one. This place is run by advisors. I'm the CEO. I'm not going to say I run it alone because I don't. I have a great team, but we run this business. We love our input. Duran's a great partner, very thoughtful, very engaged. His team, Terry Cowson, the team are awesome. But that is a distinction for sure. The second is because we're just in about, maybe we're in the second inning of this. So there is real equity growth here. This equity is going to be really valuable. And you've got firms out there that have already done that. So when we're competing against them, I say I would join them if it were 10 years ago, because those guys did really, really well. That stock price went up a lot. But when you've got firms that are already valued at 2 and 3 and 4 billion dollars, I don't think there's a lot of lift. There's going to be great equity opportunity for our partners. Now, that won't always be true. 5 years from now, unfortunately, we'll be like a lot of those firms where we're going to be really, really big and the valuations will be really substantial. But the people that take the ride with us over the next 3 or 4 years they're all going to win. And that's very exciting for us.
So one thing that I find a little ironic about how this profession has evolved over time is going back to 84 or 85. I bought my first stock in 1978 when I was in high school. So I've been an active investor for many, many decades. I followed the whole profession back in the whole commission business days. But what I find interesting is so many of the people that left the big wirehouses to become independent because they didn't want the bureaucracy. They didn't want to have to sell the firm's products and all that kind of stuff. And so they go independent. And now what happens is all the independents are getting together and now they're
100%.
creating the big
100%.
firms again.
You
Okay.
are.
So tell me, how are you going to avoid that? How are you
Yeah,
going to avoid becoming the thing that you
yeah.
wanted to get away from?
You are spot on. Duran makes this comment all the time. He writes about this all the time. That what's happened is these large RIAs look very much like the wirehouses because they've become these giant bureaucracies. When I talk to my people, the first question always is why. So when we come up with a policy or something that you won't let people do, or something that you're creating a nuisance to them, my question to my manager team is why. If there isn't a real why, when you talk about how we operate as advisors and that you make their life difficult, that's a problem. And you have to know who they serve. These people, the management team here, the employees here, they serve the client and they serve the advisor. And people can't forget that. Now you've got to be compliant and we've got to protect our enterprise. And sometimes people can't do everything they want to do, and that's okay. But we don't want to be a big bureaucracy. I have no interest in that. I left a bureaucracy. I don't want to be on an aircraft carrier. If we're looking at something and there's something that we can do that'll benefit our clients and it'll benefit our business, if we can take 90 days and add that, we want to do that. I don't want to take 3 years. We're not going to run a business that's at the lowest common denominator because we're protecting this massive ship. So yeah, but it's a great point, Steve, because that's where a lot of these firms have come. They've become these
Right.
large bureaucracies that they left.
Well, here's where I think there's a real tension. And let's go back to Joe Duran here.
Yeah.
So I did some work with Joe back in the United Capital days. And so they're all about financial life planning. They're all about, we want to have one process where you could go talk to a United Capital advisor in New Jersey and you get a
Yeah.
similar experience to a United Capital advisor in
Absolutely.
California. So we've
Absolutely.
got this one brand, all
Yes.
right, which is
One
great.
point. One
One
point.
point. Okay. So how do you square, and you've rebranded, and let's
Yeah.
talk about that here
Yeah.
at
Yeah.
some
Yeah.
point as well. But how do you square, we want to have one brand, and I'm thinking, I'm putting words in your mouth, maybe we want to have one consistent experience of people working with you.
Yes.
So how do you square that with, we don't want a bureaucracy, we don't want to dictate from on high that you've got to do it this way.
Yeah.
How do you square that?
Sure. It's a great question. I think first you have to make it something that they want. If the big wirehouses, or if my old employer or my old institution, if they created an environment that advisors wanted, people wouldn't leave and people would not resent what you asked them to do. Remember, I'm an advisor. We are advisors. This is run by advisors. So centralized services is what you're describing, which is really important. But the reason that we want centralized service isn't so much that we can pigeonhole everybody and tell them what to do. We have an advisor council, so we don't make any changes around here for anything, whether it's how we operate our think tanks, how we do our proposal work, what our client website looks like, or our client portals look like. Everything is okay, guys. What do you think? And some of that comes from client survey, but it goes to the advisor council. So we're not making any changes without them. But if you're thoughtful about what you ask people to do and how you ask them to do it, if it makes sense for them, and by centralized services improves everybody's margin. You want centralized service, not its value add for the institution, obviously for the company. At one point, we'll get a better multiple someday if we are truly a centralized, scalable firm, which we are. But the reason that's more important is when I bring an advisor in, what I try to do first is I try to improve their P&L. So I talked to a firm last week. They're $1.4 billion in assets, four primary advisors. They're like 21 people. I run $2.3 billion within OnePoint with 8 people. And so the difference is a lot of these people are building firms within firms because their firms aren't supporting what they need. We don't do that. We build businesses within a firm. So we brought on a great group in Chicago. We're onboarding a group in Minneapolis right now. We're going to be onboarding a group in Orlando in about 6 weeks. The way we look at this is you're joining the Navy, and the Navy is going to support services, and you can use them or not. If they don't use them, then that's more because we're not giving them something that they want. So we have to make sure we're providing things that help them, that are accretive to their P&L, because they profit from leveraging their P&L, right? The more money the P&L makes, the more money they make. And so to me, the first thing I want to do is I say, Steve, join us. And I'm looking at your P&L and we scrub it really carefully, not to get rid of anybody, because I'm not a PE guy. What I want to do is say, are these people doing things that maybe they could be doing things that are more client focused and be something that they would enjoy more and could be more creative to your business. And by the way, these other people that are doing these administrative tasks, I need them. Let me pull them onto my P&L and let me plug them into our centralized services. We give them an opportunity to grow, right? Because we'll be a firm of 800 people ultimately, or 1,000 people, not 20. And they leverage, they get a better share price, by the way, and they're more profitable. We always talk about three things: alignment, capacity, and scale. We have to be completely aligned for this to work. We have to create capacity, and we have to be able to do it in a scalable way so it doesn't cost a fortune. Look, any billion-dollar advisor out there working for these large institutions can build a really great business and provide really great service. The question is, at what cost? Are they on a 10% or a 20% profit margin? That's crazy to me. And by centralizing services and sharing as a group, and if we're all rowing in the same direction, it's efficient and everybody's margins are much better and it's better for the firm. Yeah, but
And
I don't want
is
to ask any.
yeah, is everybody operating on their own mini P&L
Yeah,
or
so if
okay.
you're a partner, you have equity. We own the practice, right? The business is owned by the firm, as is mine, but we operate on our own P&L. So your W-2 is a percentage of your P&L. Because if you grow your P&L, your comp should grow. We shouldn't keep that. It's something I always say to people, and it's 100% true. I don't want to win. I just don't want to lose. Meaning, if we make a deal, I don't want to take your business for less than it's worth because we're going to become partners. And I pledged a fraternity in 1980, and we had a couple of knuckleheads in the fraternity, and they just abused the hell out of us. And I never understood why these guys were abusing us so much because in 9 weeks, we're all supposed to be fraternity brothers. And at the end of the day, those guys that were really ridiculous, I never liked those guys. I never got over it because they were bad. And the reality is, if I'm going to have partners for the rest of our careers, I don't want anyone to feel that they got beat. And at the same time, though, I don't want to get beat. I've got to protect my shareholders' equity. We just want to get a fair deal. I signed the same contract. Partners signed the same contract. We all have the same agreements. We all own the same stock. So we all, if you don't like the operating agreement and you won't sign it, well, it's the operating agreement I signed, right? Because we're all equal. We just have different amounts of shares.
How do you keep growing as the firm gets bigger? So you've talked
Yeah,
about I think you said you want to have 5 billion of inorganic growth and then you want to have
right. That's
7 to
our goal.
10%. Yeah,
Yep.
7 to 10% of organic growth. Of course, everybody's talking about how hard it is to get organic growth and I think
Yeah.
across the industry it's probably in the low single digits, but of course that it's really a barbell. There's a small number of firms that are doing really well, a large
Yeah.
number of firms that are either flat to negative organic growth. So you're merging with these firms, you're buying these firms, you've got all these advisors. So again, getting back to the question I asked you personally earlier,
Yeah.
how do you get all these advisors who are financially independent? How much, I'm going to say pressure, maybe not the
Yeah.
right word, but how
Yeah.
much of an expectation do you have on all of your advisors that you need to
Yeah.
grow 7 to 10%
100,
organically? Or is it like, hey, do what you want, it's your P&L. If you want to make more money, great, we're here to support you. If you don't, I'm not going to crack the whip. How do you
well,
think about
again,
that?
yeah, look, we're not penalizing or punishing anyone. I always say nobody has to go through the spanking machine if they're not
Yeah.
growing. At the same time, though, as we're making decisions about who's going to be a partner, who we're going to bring into the firm, we're looking for growth-oriented advisors, and we're here to help them grow. And so, and look, we have monthly calls with small groups, like people will call that a study group, sharing best practices. We just flew all of our partners into Palm Beach. We just got back from that last week. We spent 2 days really focused on in the mornings, how do we help each other grow? And we talk about the personal responsibility you have as a partner. Listen, I have a personal responsibility to them. I don't like to say I run this place because we have lots of people that run this place, but I am responsible for this place. And I also am responsible for a really large book. And people always say, well, Liz, how do you do that? But at the end of the day, I have responsibility to my partners. Because if I represent $2.3 billion of this $15 billion book, if I decide that I'm going to have zero growth, well, that just had a negative impact on the overall organic growth of the firm. I don't do it for the money. We give a bonus for organic growth. I donated half my bonus back. I thought it was weird that the CEO would get a bonus for organic growth. I thought it's not my responsibility. So I donated half back so we could have a bigger partner fly it. So at the end of the day, everybody knows, and we talk about it, that we have a responsibility to each other. Now circumstances happen. Sometimes people have issues during the course of the year, but everybody owes their partners to do their very, very best. And we are here to support that. And I think that we have great partners. I'm so proud of the people that, that I am partners with. We had so much fun last week, just talking to each other, helping each other. It's a great culture. I think if you start with growth-oriented advisors, I think it makes it a lot easier. We're not
Mhm.
interested in zoo-fed bears. We're just not. We're not interested in lifestyle partners. If you're a
Mhm.
lifestyle advisor, you want to be a 1099 and share our platform, we're happy to help you make your life easier, but you're not getting equity
Mhm.
if you're not interested in growing.
So roughly how many employees do you have now?
Yeah, so we're about 200 people. We hired 40 people in 2025 in Parsippany at headquarters. But yeah, I'm sure we'll hire 25 more people this year to support growth. But the firms we bring on, it could be 100 people. All these advisors have their own people. So yeah, it's
And
fun.
roughly what percent of your 200 or so folks actually have equity in the firm?
I would say about 45 people.
Okay.
Yeah, I would
Yeah.
say because there's 35 advisors, well, probably more than that, but probably 55 because a lot of the
Okay.
partner staff have, all of the management team have, we have what we call a MIP, Management Incentive Plan, which is equity. So there's a lot. Everybody does have equity, but there's a lot of people here with equity.
And how do you think about that in
Yeah.
terms of equity ownership? Some folks are like, well, I want to have it all. Others are like, I want to spread it widely. So what's your
Yeah, I
philosophy
mean,
on
look,
ownership?
I would like more people to have equity, not less, personally. I gave away a chunk of equity to my personal team because they've been with me for a long time, and if we're all going to make money someday, everybody should. So it's hard for sure to give everybody equity. It's complicated. It's hard to manage. It gets to be a bit expensive, but we are very, very aligned here as partners, and certainly the people that run this firm, that people need to be incentivized and everybody should win. For years, I would tell advisors, you should really be careful about how you take care of the people that work for you. Because when you're out on the golf course on Friday and you're playing golf and your secretary or assistant or whatever is in the office and somebody calls in, they have a choice of how they answer that phone and what they say to that client. And I like to think that my people love me because I took care of them. So they weren't like, oh, Friday, Andy's never here on a Friday. He just plays golf on Fridays. Are you kidding me? I like to say, yeah, Andy's at another meeting. Can we call you back? And not because some assistant's mad at you because you're making all this money and they're not. And so to us, we've always paid our people very well. We have almost no turnover here. Turnover is the worst thing for any business is turnover. It's very,
Mhm.
very destructive. So if you pay people fairly, and we work really hard, and I can be a pain in the ass to deal with, so I have to pay combat pay, I think. So my people they do really, really well, which is awesome.
So tell me about that. You're a pain in the ass. In
Yeah.
what way?
Well, because it's hard to leave here at 5 o'clock. I don't leave here before 6:30 or 7. And I know sometimes like people are looking at me like I want to go home. And I'm like, no, you can go home. I get it. It's my business. When you work for somebody that works quite a bit and is very, very, look, this is a passion for me. And so I imagine, and look, we want it to be right. When I challenge these guys, my analyst team, I'm like, guys, they show me a proposal I'm reviewing, and it's not what it should be. And I'm like, guys, you need to think, the way I think. Like you're the advisor. Would you do this yourself? Like, why would you recommend somebody do this? It doesn't make sense to me. And so, yeah, I'm a pain in the ass. We expect people to be really, really good. It's not free. We pay them well, but then we demand excellence from them. And they get it though. And I think the tenure of the average employee here, I think demonstrates this is a great place to work. We got some award. I always am suspect of these awards, but we were a top 50 RAA firm for employees to work for last year, and everybody said, "Oh, that was a really big deal." How the hell you figure that out? I don't know, but better, I guess, to win than not to win. But the one thing that I know for sure that is proof to me is that if you've only been here 3 years, it's probably because you're only 27 years old. Because we literally there's a woman that sits outside my office that's been with us she's not my assistant, but assistant for 40 years. Our receptionist has been with us for 30 years. Nobody leaves here for the most part. And that's important because I think the clients get to know them. I think there's a sense of stability. They learn their jobs. There's a really good sense of sort of family. And we talk about this idea that everybody talks about a family. And I say, well, and this is a Duranism, but I like to take as many Duranisms as I can. And we had this conversation. Joe said, look, we love your family environment, and that's really important, but we have to operate like a professional team because teammates are responsible to each other. Families can tolerate lots and lots of bad behavior or disappointment. And so we love our people, but we think of them more as all being on our team, and all teammates have responsibility to their other teammates. But we've been blessed with amazing talent here, just amazing talent.
Let's look forward.
Okay.
I think there's a lot of cross currents that are going on in the profession, in the world, demographics and everything. So we've had people talking for decades about this huge transfer of wealth.
Yeah.
We've got the baby boomers, or most of them are retired, except for people like you and I that
Yeah,
are
exactly.
still working at it. We've got the younger generations who grew up as digital natives. We've got AI. We've got all these things going on. How do you don't give me a Pollyannish, oh, everything's going to be wonderful. It's going to grow
Yeah.
forever. Okay.
Yeah.
Don't give me that. But how do
Yeah.
you see the future of financial advice given
Yeah.
AI, given
Yeah.
changing demographics, knowing how hard it is to get organic growth today?
Yeah. Yeah.
How do
Yeah.
you see the future of advice?
Yeah, so I think the most important thing is, and look, I'm not the technology guy, obviously. I'm 64 years old. I don't know whether you're great with technology. I'm not. We have really good, smart young people here. I have two data engineers on our team. People talk about data. What do you do with data? Well, if you don't have people to do something with the data, then what good is the data? I think, Steve, the most important thing is that you better lean into AI heavy because it is going to change things. And so that means that, your client app better be something that clients actually want. The ease of doing business and AI will help with that. We've got all kinds of things going on right now. We're spending lots of money, lots of time, lots of consultants. I would say that at the lower end of the business, there's no doubt that it will be impacted. You're not going out probably and picking up files under $1 million or $500,000. Certainly not for a couple $100,000, because that's going to be Robinhood and all of these AI and because they don't need it. And the do-it-yourselfers, it'll be easier to be a do-it-yourselfer. But at the end of the day, I think if you expand your services, if you're just going to be a money manager, an asset allocator, you're dead in the water because nobody needs to pay you to be an asset allocator. But if you pay attention to tax and estate planning and provide all of the different planning and services that people need, certainly at the higher end, I don't think we have an issue. And people talk about fee compression. There will be fee compression, not that the fees go down, but that the services you have to offer and add cost more money, which I would call it not fee compression, I would call it margin compression, where
Or service expansion? We're doing more
well,
work
sure,
for the same
exactly,
fee. Yeah.
100%, and that I
Yeah.
believe is true. Look, we're going to
Yeah.
be doing, we're bringing on tax, we're bringing on legal, we're doing all the things that lots of firms are doing, which I think you need to. But if you are offering a robust suite of services, if you can be that one call for a client, because at the end of the day, people are busy and successful people are busy, and they're smart. If I always say to my clients, and I've got financial clients, Wall Street clients, they're all smarter than me. They could all do this if they had the time to do it, but they don't have the time or the inclination to do it. And I don't think technology particularly changes that. So yep, it's going to look different. Maybe AI will help on the prospecting side to some extent because mining information, data mining, prospecting, there are some interesting things out there that people are doing. But I do think that it'll be harder for a young advisor to come in and build a business the way we built a business. I don't think that works anymore. But I think though that you'll probably have more advisors joining existing advisors. And that's what we're seeing today. You don't see very many kids coming into the business today and building a book themselves. It seems like most people are joining somebody else because it is difficult. But yeah, I think if it's built right and if people are providing the right service to clients and if they're really value add, I think that we've got decades to be able to work with clients and be in the business that we're in. But it is
Yeah.
going to change, and you better change with it, or you're going to be in trouble. Yeah, for sure. And we
Yeah.
get
Yeah. And if I heard you correctly, I agree with what you said. So what I heard you say is at the lower end, 500,000 million, 2 million, pick some number here. Technology is going to make it easier and easier for people to do
no
that.
doubt.
And I
Yeah,
also think the firms like Schwab and Fidelity and Vanguard, Robinhood, some of these large firms, they're going to be able to make it very easy for folks at that level. And they do today, but I think
yeah. I
it's
was
going to
going to
be
say,
even more so.
listen. It's funny. We are their customer, and they are a competitor.
Right. I think
Time,
they're gonna be even more of a
no
competitor
doubt.
going forward, and we've
They're all
certainly
getting
seen
more,
that.
yeah, they're
Right.
getting more aggressive.
And so
Absolutely.
it seems like for advisors like you and people listening to this, that we're going to have to move more upscale over
You
time
bet.
because
You
those are
bet.
the people that, to your point, they don't have the time. They have the smarts, but they don't have the time or the inclination to want to spend their time doing it. I could do my own taxes, but I hate doing taxes. So I
Right.
pay somebody good money to do my
Right.
taxes because I don't want to do it. And probably
Yeah.
technology probably could do it today. We saw
Yeah.
Altruist come out with their
Yeah.
their
Yeah.
tax thing that sort of tanked all the financial stocks. So yeah, I think we're going to have to move more upscale. And I think so there's going to be a smaller number of clients that advisors can work with because the less complicated folks are going to be going to some of the bigger
Yeah.
firms that really work with on a mass
And I
basis as
think,
opposed to a personalized basis.
and I think that's true, but I think it takes longer than everybody thinks.
Hmm.
Because at the end of the day, it's still complicated. There's still a lot of emotion involved. I can buy stock on my app, I can sell a stock on my app, I can do all of that. But if I'm 25 years old or 30 years old, there's still the problem with emotion, fear and greed, and making mistakes. And at the end of the day, one of the things that will save our industry is everybody wants to have somebody they can blame, and I can't blame myself. And so if it's good, I can take the credit, but if it's bad, I can blame Andy. And I think there's something to that. I don't think that the death of this business is anytime soon. But
Right.
there's no doubt that the kids are much more adapt to technology and they can do things. But people have probably hurt themselves in the last couple of years as well. Think about all the
Hmm.
people that bought Bitcoin in the last 3 or 4 months. Think about the people that were chasing silver. And we started a silver position 4 years ago. But we sold our silver position mid-January because when something goes parabolic, it's time to get out. Think about all the people that got in because they're watching this, right? It was a meme trade. So I wouldn't underestimate the value of a rational adult as being part of a conversation. It doesn't matter how old you are, it doesn't make you a rational adult when it comes to investing. So I
Hmm.
think there's going to be some help there, but you got to add value. You've got to add value or you're going to be in trouble.
Hmm. So, what's the end game for you?
Yeah.
So, you mentioned earlier about we've been hearing for a number of years now that a couple of these big mega RIAs, 100 billion, 200 billion, are actually going to merge and create some super
Yeah.
RIA. Hasn't happened yet. Where do you see yourself on that ecosystem
Yeah,
5 years from now, let's
I don't
say?
want to be I don't want to be one of them. So that my goal is not to be $1 trillion RIA and be head of the empire. I have no interest in that at all. It's not my skill set, and I have no interest. We look at this as a train ride. So we'll grow this business, get to 50 billion or so, probably need a little bit of capital at that point, and then there'll be some kind of recap. I know one thing for sure, we will not take the highest bidder because I know who the highest bidders are going to be, and I don't want to be with them. I'm not going to do that. I'm not going to jump back into that platform, if you will. So, and then we'll give everybody an opportunity to take some chips off the table. We'll put some recapitalize the firm or get more capital into the firm, and then we'll take it to the next iteration. And maybe that's when we go from 50 to 100. But I've got kids here. My brother has kids here. We have lots and lots of service. My son-in-law is on my team. My daughter's on my team. My two nephews are on my brother Scott's team. We've got kids everywhere. Lots of our advisors have kids. This is something that we are building to last. And my average, I was thinking about this in the wind this morning. The average employee on my team is probably 40. So I'm 64, but they're 40. This thing can't end when I'm done because these guys have been working here. My 40-year-olds have been here for 15 or 20 years. I don't want them to all go and have to find a job when they're 50 because the boss cashed out. So no, this is going to be, we're building something that's going to be here for a long, long time.
Excellent. All right, Andy, this has been great. So, if folks want
My
to
pleasure.
learn more about OnePoint, what's the best way to connect with you guys?
Yes, so you can hit our website, obviously, onepointbfg.com. You can call me.
Yeah, that's
Yeah.
right.
And listen,
What's
we do, and
yeah,
we're out there. I do a
yeah.
bunch of stuff. Chuck Downs and I do an Advisor Compass podcast. I've been doing work with advisors for decades because my favorite thing when I think about this idea of leverage, you asked me before what motivates you. Well, one thing that motivates me is that if I can create so much, I can give away so much. But think about this, with what I know and what I've learned and what I can share, there are hundreds and hundreds of advisors out there, maybe thousands that have benefited from what my brother and I have done over the years, the seminar work and the podcasts and all the videos and everything we've done. And that to me is amazing that your life could actually have meant something, not just my own personal P&L, but there's people out there that would actually say, yeah, he really helped me. And so we're out there all over the place. I've got stuff everywhere. It's not hard to find us.
Excellent. All right, Andy, appreciate you being on the
My,
show.
my, my pleasure. It's great.